Welcome to episode 5, guys. Today we're going to talk about liquidity. Liquidity is literally the basic of everything. The basic in trading, and surely in our strategy, price action, liquidity is everything for us. How we trade, how we look at the market, how the market is moving, literally anything. So let's start immediately as always. Liquidity. The pure definition of liquidity is how easy an asset can be bought or sold without price moving too much. So for example, Bitcoin is of course the number one asset in crypto, has a big market cap, a lot of money is in this coin. But for example, let's say someone buys for $1 billion Bitcoin. Of course, that's unrealistic, but let's say for the example, price will go up, and he can't buy all of his Bitcoin at the current market price because at the moment they're not 1 billion sell orders at the current price. So, but now another example, if I want to buy 1 Bitcoin at the current price, I can probably do it all for this current price because 1 Bitcoin is not that much. For example, I can go to the order books of the exchange and look at it. But for example, at this current price, changes every second, of course. At this current price level, there are 500 Bitcoin being sold and bought. For example, if there are 510 Bitcoin being bought and only 500 sold at this price level, price will go up. So surely with meme coins or coins that have a low market cap, if you buy for $1,000, for example, price might go up a lot, but then you don't buy all the 1,000 at one point. So Bitcoin, you can buy everything at one point, surely, if you're not some millionaire, billionaire. But just understand that liquidity is usually defined as how easy an asset can be bought or sold without price moving too much. How much liquidity is there? Is there a lot of liquidity in the market? So a lot of buy and sell orders in the market. Now, how we define liquidity, and it's not a definition, that's just how we use it, and a lot of strategists use it. We define liquidity as zones or levels or places where there are a lot of buy or sell orders. So where price will go to and where price will probably interact with. These zones become magnets for price. Price will always go to liquidity because, as I just explained, for example, if there's at the moment at this price, and that's not just 90,000, 89,000, that's 89,310.9 and another decimal behind it. It's very, very precise because Bitcoin is of course a big asset, so it's very, very precise. So for example, if at this price 500 Bitcoin will be bought and only 250 will be sold, they move to the next level. As you can think about this, they move to the next price level. Price goes up because they can't get that full 500 Bitcoin on that level. They move to the next one. And liquidity zones are zones with a lot of orders, with a lot of buy or sell orders. So price wants to go there because price is leveling up or leveling down. The current levels can't keep up with with the buy or sell pressure because there's a lot of, for example, buy orders, a lot of sell orders, and then price will go back to the zones where there's a lot of liquidity and there are tons of buy or sell orders, and price can pick up all the liquidity there and then just keep moving. Just do it like this. Price is moving, they see there's a lot of buy pressure or sell pressure. They feel like, yeah, we can't do it in this zone, there's not enough on these levels, so we go to a zone with liquidity where we have no problem picking up all the orders, and then we're fine again. Maybe this explanation isn't that well, or you're a bit confused, but I'll show examples now and zones where liquidity is, and now you surely understand it. So liquidity mostly builds up around highs and lows. Not the exact high and the exact low, but around it. As I already explained in the previous videos about trends, I believe, because I explained what a reversal is, and I explained in support and resistance that why does support and resistance work, because there's liquidity, a lot of liquidity, and buy and sell orders. So let's look at an example. We're on the Bitcoin chart. I don't have to go back to 2013 on one specific thing. No, this is a very common thing and works on every coin, and you can easily find it. So for example, Bitcoin, they made a new low here. This low, exactly, there's not that much liquidity there. Where is a lot of liquidity? In this zone. This is a specific level, but you guys don't know the specific levels yet, so I'll make a zone in this zone. Why? Because price made an entire new low, price started gaining again, just ranging a bit, and from this hold, you can't say that there yet. You can say that when price is here. You can say that of course they made new highs. You can't, when price is here, say of course this will be the zone with liquidity. See price, yeah, gained here, made a quick retest. You see those 3 red candles, and then price made new highs. So in this range, you know that after they made those highs, there will be a lot of liquidity because price really needed to push. There had to be a lot of buy pressure, a lot of buy orders to pump this price. Surely, I will come back later to this, why this is a very important zone and not just a liquidity zone, because some liquidity zones have more liquidity or are more important or have a higher probability of being a successful trade, because we're in a huge downtrend here, as you see, a huge downtrend, and price finally breaks some sort of levels. Of course, we're not back fully at the top, but price starts breaking some levels, and then of course, in this zone there was a lot of buy pressure, a lot of buy orders, so this is an important liquidity zone. So you might ask, why is this an important liquidity zone? I understand why you're asking this. When I started learning, I really wanted to know exactly why is this. If you're not interested in that, and that's not something that goes on in your mind, then you really don't have to learn that, because it's not really that important. Of course, if you want to become smarter or like explain it to other people and don't sound as someone who just copies random things, you can listen to it, but it's not that important. So a lot of people bought or longed. Of course, these terminology I said after the first video, check in the server, learn these basic. A long is of course when you buy and expect price to rise. So a lot of people longed here, and here they took their profits, but that doesn't really matter. So a lot of people longed here. Now, when you long, even market makers, even big institutions, surely if they don't just buy for the long term, they want to push price up and down, they set a stop loss. So they buy, for example, set a stop loss here. These are all stop losses. Stop loss, of course, you know what it is. If price hits this, you instantly sell your things and you're out with a loss. That just protects your capital. So when price goes up, all these people who longed are happy. All those people who longed are happy. They start taking profits. As you see, price is not going up to the moon. They start taking profits in this zone. Most people took their profits. Now they of course move their stop losses also up. Most people do it when they're up in price, just move their stop loss up, or set it at break even. So when price doesn't have enough buy orders anymore, people are taking profits, which also means taking a profit, and this is something maybe too technical already, but when you take a profit, that is actually you selling your asset. That means price is going down. So these people who longed here they sold, so price is going down. Now very important is when price goes down, it hits all these stop losses, and Nat just explained what a stop loss is, what it actually does. It's just a market order that says sell. So there's not necessarily many people selling here, it's just price hitting all those stop losses, and with many stop losses being there, it accelerates price and makes a very sharp correction, as you see here. Later in the PA courses, you'll learn exactly why this is the level and not just this broad explanation. But you just know in this zone there's liquidity, and I called this level as well, just for information, doesn't really matter, but daily updates in the server, you just know in this zone there's a lot of liquidity and price will retest it. Now it was after a week and 2-3 days. Can also be after 4 years. On the daily or the weekly, price retest those liquidity zones from a year ago, 2 years ago. I saw lately, it was I think around a year ago, that the euro against the dollar, or dollar against the euro, I don't know the exact pair because I don't trade forex, but they retested the hold or the liquidity zone that was important from 2013 or something. So you see, these zones actually work. This is not just playing, it is playing probability, but it's not just sometimes these zones work. No, these zones have actual meaning. There's liquidity in the market, there are buys and sell orders, and that's the most important thing, because price goes up and down because of these buy and sell orders. So you're really trading the roots of the market. What is really nice with those liquidity sweeps, as we call it, the sweep also mentioned, and you had to learn those words. A sweep is when the wick closes below a level or zone, but the body doesn't. So price went there during that time frame, but it didn't close there. A sweep or a wick is a prime example of how price picked up liquidity. We can look at this example. Let me remove the box and just set a line for the example. So we can zoom in here. So this is just a hold. We indicate the hold here. And we see price perfectly sweeped. Sweep is a prime example. Of course, on the lower time frame, these are just bodies. But this means that price quickly went there, picked everything up what they needed. Basically, you go to a store quickly, you grab everything you need, and then you were gone again. Sorry for this weird example, but that's just basically what price does. Not enough, there was just not enough buy orders in the market, so they retraced to this zone of liquidity, picked up everything they need, and continued the trend up. So if your level gets wicked, that's a very good indication that you were right about your level and that price actually picked up liquidity. For example, if this was your level, or this was the level to look at, and you see this, then this was not really a level with a lot of liquidity, because price, they didn't do that much. Of course, this can still be a zone, and this could still be the right level, but then you know the probability was just not there, and maybe of course, as I said, you could be right, but maybe that was not the right level, and you should go back on the chart and look if you made a mistake, which is surely very common in your early months and years as a trader. So as mentioned, liquidity is the base of price action trading. We wait for liquidity, we wait for price to sweep a level or to go to zones with a lot of liquidity, because we know there in that zone or that level is the probability the highest that there will be some movement in any direction. One last thing I want to talk about are liquidity grabs, or more specifically stop loss hunters. So stop loss hunters are market makers. Market makers are people, institutions with a lot of money that will literally go and find your stop loss. Why is that? Because in some setups, some trades, a lot of people set their stop loss at a set level, and when the exchange sees that, or the market maker sees that, they see, if we drive price to that stop loss, we make a lot of money. So they actually start putting a lot of money into the market to make price go to your direction. So sometimes, actually at the start I had that a lot, that you see price, it's your entry, you might do it well, and then just price does this and makes a move. And that's just fucked up. I know that's very, very painful. Still sometimes happens to me that you just get stopped out, and that's very, very painful. Surely if the move happens right after that. But yeah, that's why you have to be careful. If that happens a lot, you might set your stop loss right into the liquidity and not just below the liquidity. But that's something you can work on easily. And that's not something for now, but just so you know, just remember this, that if you get stopped out with a very tiny margin, it's probably this reason. So to summarize all of this, the longest videos of the series so far, I talked a lot, maybe the explanation wasn't top, but you should understand majority of this. Remember, liquidity zones are zones or levels with a lot of buy and sell orders where price will want to go to, because that just acts like a magnet, it attracts price, and that's basically it. It's the foundation of a strategy. So if you don't understand it yet, which is completely normal, maybe watch again. You can join the Discord, there's just text with maybe a bit better explanation. If you still don't understand it, I'm always there to answer questions. But for now, that was it. I'll see you guys on episode 6.